Why prices stay high even after inflation slows. Inflation has been one of the most discussed economic issues in recent years. Many people regularly hear headlines saying inflation is cooling, easing, or slowing down. Yet when they shop for groceries, pay rent, cover transportation costs, or handle monthly bills, prices still feel uncomfortably high. This creates a common and understandable question. If inflation is slowing, why don't prices come back down? To answer this, it's important to clearly understand what inflation actually measures, and just as importantly, what it does not measure. Inflation tracks the rate at which prices increase over time, not whether prices are high or affordable. When inflation slows, it means prices are rising more slowly than before. It does not mean prices are falling or returning to earlier levels. A simple way to think about inflation is to imagine a moving vehicle. If a car slows down from 80 miles per hour to 30 miles per hour, it is still moving forward. It hasn't stopped, and it certainly hasn't reversed direction. Inflation works the same way. Slower inflation still means prices are increasing, just at a reduced pace. For prices across the economy to actually decline, something else would need to happen: deflation. Deflation occurs when prices fall consistently over time. While that may sound appealing, deflation is rare and often linked to economic slowdowns, weaker demand, and job losses. Because of these risks, modern economies generally aim to avoid deflation and instead target low, steady inflation. Another key reason prices remain high is that many businesses now operate with permanently higher costs. During periods of elevated inflation, companies face rising expenses for wages, transportation, energy, rent, insurance, and raw materials. When these costs increase, businesses usually raise prices to protect their margins. Once prices move higher, they rarely come back down unless companies face strong competition or a clear drop in demand. If consumers continue purchasing goods and services, even while feeling frustrated, businesses have little financial reason to reverse those price increases. Labor costs play an especially important role. In many industries, wages increased as employers competed for workers. Higher wages can benefit employees, but they also raise operating costs for companies. To cover payroll, businesses often pass those higher costs on to consumers through higher prices, and these adjustments tend to remain in place. Consumer behavior also influences pricing. Over time, people adapt to higher prices, even if they don't like them. As expectations adjust, demand often holds up better than anticipated. When demand stays relatively strong, prices are more likely to remain elevated. Supply chains are another important factor. While global supply disruptions have eased compared to earlier years, supply systems have not fully returned to pre-crisis efficiency. Shipping, manufacturing, and logistics costs may be lower than their peak, but they are still higher than they were several years ago. These lingering costs continue to affect final prices. Housing costs are one of the biggest reasons inflation still feels intense for many households. Rent and home prices tend to adjust slowly, but have a major impact on monthly budgets. Even when overall inflation slows, housing costs can remain elevated for long periods. Once rent increases, it rarely declines unless there is a significant change in supply or demand. Energy prices also influence nearly every part of the economy. Transportation, food production, utilities, and manufacturing all depend on energy. Even modestly higher energy costs can quietly keep prices elevated across many sectors. It's also important to remember that inflation data represents averages. It reflects overall trends across the economy, not individual spending patterns. Some prices may stabilize or fall, while others continue to rise. If the items someone buys most often, such as food, housing, or transportation, keep increasing, it can feel like inflation hasn't slowed at all. Another reason prices don't fall easily is that widespread price declines can create economic challenges. Falling prices may discourage spending, reduce business investment, and increase unemployment. Because of this, economic systems are designed to favor stability rather than broad price reversals. Over time, incomes are expected to rise and gradually catch up with higher prices. When wages grow faster than inflation, purchasing power improves, even if prices remain high. This adjustment takes time, which is why financial pressure often lingers well after inflation headlines improve. Technology and competition can also help moderate prices in certain industries. When innovation increases efficiency or new competitors enter the market, some prices may stabilize or decline. However, these changes happen unevenly and slowly.